Okay, so what we're going to do today in this fantastic video is talk about the balance sheet. So I'm going to actually break down what the balance sheet is and some other basic terminology in accounting and finance, because you might be somebody that's sat there at home that either wants to know a little bit more about, different terminology and what a balance sheet is, or you might be somebody who is looking to study and, getting these textbooks out, or you've had a little Google search and it's not quite giving you the answer that you're looking for. So let's take a little bit of a deep dive into that. So what the heck is a balance sheet? So basically, if we really break this down, in accounting we have two pieces of paper, let's just say. So most set of accounts is these two pieces of paper, and on one of them it shows all of your expenses and all of your income. So all of your costs, all of your income is going to give you net profit at the end. Then you're going to get taxed on it if you've made a profit, and then you've got your profit after tax. Fine, easy to understand. But in the second sheet, we've got the balance sheet, and it's sometimes called the statement of financial position because we've got different accounting standards at play. So if you adopt IFRS, which is International Financial Reporting Standards, you're going to refer to it as the statement of financial position. But if you adopt the UK GAAP, then you're going to refer to it as the balance sheet. So basically, on this balance sheet, it's a picture of what's happening in your company at a certain point in time. So if we looked at the very, very top of the balance sheet, you'd find that you've got a load of non-current assets. So assets like motor vehicles, plant and machinery, computer equipment, anything that you're holding in your company for longer than 12 months effectively is going to be shown at the top. And it's going to be shown at what we call net book value. So basically, when we get an asset in, we're going to depreciate that asset over its life. And the reason why we do that is because we're spreading the cost of that asset over its life. So for instance, we don't just say, oh, you've bought a plant and machine for £5,000, so we're going to deduct that from profits in the first year, because you can have this picture going up and down, up and down, up and down of your net profit, let's just say. So in order to spread it out and to basically charge the cost of the asset over its life, we spread this in the income statement or statement of profit or loss. So what we're showing, that net book value, is the cost less that depreciation, which is where we're spreading the cost over its life. So then if we move down a little bit, we're going to have what we call current assets. So assets that we're holding in our company for less than 12 months. So this will be things like your bank balance, so how much you've got in your bank, cash balances, any amounts due from customers, which we refer to as debtors or trade debtors. And then we're going to have the likes of prepayments, accrued income, so income that we've not yet received but we need to account for. So if you know that you're going to receive a grant in the next month after the year end, but it actually relates to this year end, then we're going to pop that into accrued income, for instance. Then, if we move slightly down, what we're going to have is current liabilities, so the likes of overdrafts, amounts due to suppliers, accruals, so accruals for costs that we know we're going to receive but we haven't yet received the invoice. Deferred income, a lot of the time is going to be shown in there. Any accruals effectively for the likes of corporation tax, PYE, national insurance that's not yet paid, that relates to our year end, for example. And then we're going to have non-current assets, and then we're going to have non-current liabilities, so the likes of long-term loans, finance leases, etc., more than 12 months. And then at the bottom of that, we're going to have a calculation that's working out the total assets that we have minus our total liabilities, and that should equal the total amount of equity that we've got in that company. So our equity, if you don't know what that is any shares in the company, capital that's been introduced, any retained earnings, so all of your earnings brought forward plus the profit or loss in that particular period. So all of that is going to show in the equity section there. So yeah, that's just a very brief explanation of what a balance sheet is, but I hope that helps with your understanding, and if you've got any comments, queries, etc., just pop them below in the comment section and I'll do my best to get back to you. But otherwise, yeah, take care and consider subscribing, hit like if you found it useful, and yeah, I'll catch you at the next one.